aren't here, if you actually listen to this, like that, that's for people who aren't here. I bet some of them will listen to it. What should we do?
Everything.
Oh, come on. We can do anything you guys think is hard. Should we do some of these effective errors?
Yeah.
That's probably a wise thing to do. Crank through those. What did I mention? We did one periodic versus perpetual inventory. Inventory errors periodic. We did 810. Is that the one we did? No, we didn't do that one. Well, that would be okay. Oh, that's just over and understated. Let's do some dollar amounts. Okay, and 811 similar to the one we just did. Let's do instead, yeah, let's do this one. Let's do 812, exercise 812 on page 455. This is good. How would you approach something like this, you guys? Net income per books of Linda Patrick Company was determined without knowledge of the errors indicated, and you can see there's errors in ending inventory some years and none some years. All right, compare worksheet to show the adjusted net income figures. So they have the net income per books now, and what should it be for each of the 6 years? How would you go about something like this? I bet you anything you see something like this. Probably not that many years, but how would you approach this thing? What do you know about inventory and the income statement and the balance sheet? What if you did this? These assets equal liabilities plus equity. All right? Revenues less expenses is net income. I bet you know this. Okay? One of the expenses is relating to inventory is what? Inventory is one of the asset accounts, right? And one of the expenses related to inventory, the expense related to inventory is what? Cost of goods sold. True? So what we're going to do is we are going to take the beginning balance in inventory, and we're going to add the purchases, and add the freight in, less the discounts, right? Purchase discounts, purchase returns and allowances. Anyway, we're going to, and plus excise tax, whatever you pay. Okay, we're going to get net purchases, and we're going to add that to the beginning inventory, and that'll be available. Is that right? Subtract the ending inventory, and you have what? Yeah, and we can do that for every year, can't we? Okay, so let's just do it. Okay? You could use T accounts for this. You could use a little accounting equation here if you want. However you want to do it. Okay? Doesn't make any difference. Figure out a way that works for you. In 2009, the net income for books was $50,000. If we knew how much that was over or understated, we could get the correct net income, couldn't we? That's all you have to do here. Okay, if they say ending inventory is overstated by 3,000, what would you assume about the beginning inventory and the purchases? They're probably what? Fine, right? So this is fine. This is fine, right? This is fine. And ending inventory is too high by 3,000, right? What's that going to do to cost of goods sold? You take the right available and you subtract too big a number. What happens? It's too low by 3. That means your expenses are too low by 3. It didn't say anything about revenue, so I guess they're okay. So what's wrong with net income? If you lower the expenses, our expenses are too low. Right? See that? Arrow down. Okay? Our expenses are too low because our ending inventory is too high, right? Which makes what? Net income too high by 3, which makes retained earnings too high by 3. Is that true? And why does this work? What's wrong with liabilities? Well, nothing. They didn't say anything about liabilities, but what we say about inventory? It's too high by 3. And what I like about writing down the accounting equation is I can prove to myself I've analyzed it correctly. Does that make sense? Because I can see that, well, yeah, the overstatement of assets is equal to the overstatement of equity, right? You can work any of them this way. If I screw with purchases, I may get it wrong. Well, then change purchases. If I mess with beginning inventory, change that. If the liabilities are wrong, change that. Are you with me? Just like the one we did in class today where all those errors, I'm doing exactly the same process, okay? They work every time. All right, so the first year, you think net income is too high by 3. So for 2009, what do you think the net income should be? Let's see, it's 50. You think it is too high by 3. What should it have been? 47?
Yeah.
Right? Easy. Now, will that error correct itself the next year? All right, what I had here was 2000, what was the first year, 2009? 2010. What do I know about the beginning inventory of 2010? You guys do know the ending inventory of 1 year is the beginning of the next? Okay, right? I'm a humorous guy. So if it was too high at the end of 2009, what do you bet at the beginning of 2010 is too high? Right? So what will happen is that overstatement here, if I add it to the correct purchases, because they don't say anything about purchases, right? What will be wrong with available? It'll be too high by 3. Assume the ending inventory is okay. Let's assume it is, right? It's not, but let's assume for a minute it is. What will happen to cost of goods sold? By the 3. See how the error self-corrects? Both years are wrong, but it corrected itself. See it? Because the ending inventory 1 year is the beginning of the next. That's all that is, right? And you get, so you work a few of these, you guys, you'll get so it's just automatic for you. Just, okay, I see it, I see it, I see it. Okay? If you decide never to be a CPA, is this useful to know as a finance person? Oh man, yeah. What's going on when there's an error in the financials, right? And these are more complex errors. Why? Because the ending becomes the beginning. Other errors are just one time. You know, you overstate something and understate something, right? It'll, you know, it's just one time. It flows through. Put too much salary expense 1 year, add too little the next year, maybe, right? So you know, you don't have to analyze it like this. So this is one of the tougher ones, but so, right? Big deal. All right. So what that's going to do the next year then, what it's going to do the next year to us is revenues will be fine, expenses will be too high by 3, true? Which will make net income too low by 3. You're both staying with me, right?
Yeah.
All right. Now what? That's going to make equity what? Yeah, but it was 3 too high.
Oh, even.
And now you're lowering it by 3, so there is no error here now. For that one, there's no error anymore, right? And assuming the ending inventory was okay, there'd be no error here either, right? It's now zeroed out. Everything's fine. It's just each year's wrong. But when you add the 2 years together, right, it's the correct amount. Each year would be wrong. So with that one, what I would do is I would take 3,000 and add it, right? The income's too low. I'd add 3,000 to the 52 they have there, and I'd have 55. Got it? Makes sense, doesn't it? But there is an error at the end of the year, though, so I got 2 things working. I've got an overstatement of cost of goods sold by 3, and then what else happens? It says ending inventory is overstated by 9, right? Did I read it right? So I subtracted 9 too much. What's that going to do? It's going to make cost of goods sold too low by what? No, careful.
Oh, 6.
Just 6, right? Because that's going to make it too low by 9 because you subtracted too much. You added too much and then you subtracted too much, right? So what's that going to do to you? Adding 3 is going to give you 3 more. Subtracting 9 too much is going to give you 9 less. The net effect is what? 6, right? Too low by 6, which means this isn't 3, is it? Over here, it's 9 going the other way too, so it's 6, of course, right? Cost of goods sold is too low by 6, which is going to make net income what? Add those together, it's going to be too high by 6, isn't it? If net income is too high by 6, what happens? Ending inventory is what? Too high by 9? But net income's only too high by 6? And I think liabilities are okay. What must be the case with equity? It must be what, you guys? It's got to be too high by 9, doesn't it? How does that happen? Let's see. Retained earnings. The first year, what did I do? I put 3 too much in it, didn't I? There's from 2009. right? What happens from 2010? 2010. What happened? I put 6 too much in, didn't I? You guys with me? Okay, so this is 2009. This is 2010. Okay? I put 6 more too much in. What's 3 plus 6? 9. And we're in great shape, right? Okay, so I've got too much income by 9 that year, don't I? Right? Because 3 correction from the prior year, right? And 12 correction for this year, right? 12 error for this year, right? So the difference is 9. So for 2010, what's my income? It's 6 too high, right? 6 too high. So how much did they say they had?
52.
So what should it be?
46.
46,000. Got it? Is that working, guys? This is not real easy, is it? I mean, it turns your brain kind of inside out. Okay? So let's keep going. In fact, let's do this. Here's correct. Right? Here's what was wrong originally recorded. Okay, let's do that. Okay, what was it? 50 and 52? You'll see why I want to do this in a second. At the end of the 4th year, there's going to be no error. You know what's going to happen at the end of the 4th year? All the errors are going to cancel each other. They're going to, all 4 years added together are going to be just fine, because there's no error at the beginning and none at the end, huh? All right, so let's keep going. Let's try doing the same thing. I'll set up another one so you can see it a little better, right? Assets. Okay, so I'm going to try again that. It's liabilities plus equity. Where we're at right now is what? I've got too much ending inventory by how much? Was it 9,000? Yeah. Liabilities are okay. Too much ending equity by 9, right? Remember that? That was the 9. That's where we're at. Okay? You guys see it? 2009 plus 2010. Okay? I start a new year. Revenues, expenses, differences between net income. So let's do the next 2 years. Let's do 2011 and 12, I guess. By the way, could I do a little spreadsheet where I put all the years across? Yeah, one next to the other might be a nice idea, huh? And then do a T account for retained earnings. Okay, you set it up that way. Practice this stuff a little bit. All right. And then, of course, the expense in there is cost of goods sold, right? Beginning inventory plus my purchases is available. And you don't have to write all this stuff down. Once you practice it a little bit, the only reason I'm doing this is so you can see it flow through. Does that make sense? Mm-hmm. But if it helps you to do it this way, do it. What the heck? If they get complex, I always do them like that. If a whole bunch of things are changing, I'm trying to do it instead of trying to do it in my head. Okay, so for 2011, I have the wrong answer is 54,000. And for 2012, the wrong answer is 56,000. You know what? Take a look at those numbers they have. 50, 52, 54, 56, 58, 60. What does that look like to you? Gradual increase, nice smooth uptick. That's going to make their beta low, isn't it? Makes them look less risky. What might they be doing? Smoothing their income, right? Stealing revenues from one period, putting in the next, right? Moving it back and forth, or expenses. In their case, they're manipulating inventory. And by manipulating inventory, they manipulate their net income, don't they? Right? So we can find out what they really should have reported. Sort of the point of the problem, okay? All right, so I really hate it when I know how much my coffee costs. That was $2.30 for a cup of coffee. They're free at home. I don't go to the store, my wife does. I have no idea what it costs. I don't even care. But it's free, right? I can make as much as I want. Good life, huh?
You should have ate some before you came.
Well, I had 2 cuts this morning. That's my 3rd, and that's a huge one. So. It's my grandkids' fault. Anyway, okay, so what do we need to do here? What would you say about, you guys, go ahead and do this one, you guys. What would you do with 2011? Help me do it. What do you know? Beginning inventory is what?
54,000.
Well, no, that's net income. Beginning inventory. What do we know from 2010?
Beginning inventory is,
Overstated by 9, right? Isn't that what we had the last one?
Yeah.
Okay, so what would beginning be? Overstated by 9, right? You guys agree?
Mm-hmm.
What else do you know? Ending inventory, what is it?
Understated by 11.
Yeah, it's everything we need to know. We got it made, right? Okay, what's wrong with assets then, this year? At the end of 2011, right? This is the beginning of 2011, which is 2010, right? What's wrong with inventory at the end?
Yeah, understated by 11.
Too low by 11, we know that, right?
Yeah.
What's wrong with liabilities?
Nothing.
Nothing, I guess. You guys agree with that?
Mm-hmm.
What must be the case with equity?
Under by 11.
It's going to have to be under by 11 by the time we're done, right? There's nothing wrong with liabilities. Man, I already know stuff, don't I? It's really pretty easy. Okay, how about revenues? Revenues are fine. They didn't say anything about revenues, right? Just like liabilities are fine. What about purchases? Just fine, right? What's wrong with available?
Overstated by
Too high by 9. What's that going to do to cost of goods sold? Too high by 9, right? What's going to happen if you understate your ending inventory by 11? You're subtracting too small a number. What happens to cost of goods sold?
Too high by 11.
Too high by 11. So in total, cost of goods sold are overstated by how much? 20. Look at this. Cost of goods sold is too high by 20. What does that do to net income? Too low by 20. Ah, look at retained earnings here. We had 2009, right? Too high by 3. 2010, too high by 6, right? What do we have for 2011? Too low by 20. What's that going to be? What's the difference? Too low by 11. It is, isn't it? A 9 credit less a 20 debit. Ta-da! That's what caused this. And we're ready to do the next year. Start getting easy, don't they? Okay? What do we know about the next year, 2012? What's wrong with ending inventory at 2012? What does it say?
Wait, there's no error.
Yeah, nothing's wrong. What's wrong with liabilities? Nothing. What must be wrong with equity? Nothing. Even I can do this. Okay, now what? We know nothing's wrong with revenues. Okay? All right, beginning inventory, what's wrong with it? If ending is low by 11 the year before, what do we have for this year?
Too low by 11.
Too low by 11. They didn't say anything about purchases, so I guess it's okay. Available must be what? Too low by 11. Oh, ending is okay, right? They said no error. Guess what? Cost of goods sold is what? Too low by 11. Cost of goods sold's a major expense. Too low by 11, right? If revenues are okay, cost of goods sold's too low by 11, what do you get? Okay, put that into retained earnings here, right? So that was 2010, this was 2011. What do we do in 2012? We put in 11 too much, don't we? Retained earnings was too low by 11, but now we put in 11 too much. What happens to retained earnings? There is nothing wrong at the end of 2012, right? It corrected itself, didn't it? Okay, so you tell me, what should income have been in 2011? They have on their books 54,000, right?
Mm-hmm.
What should it be if we are too low by 20? 74,000. And in 2012, our income is too high by 11. What should it be? Okay, now add up those 4 years and see if we did it right. Because I started with no error, I end up with no error. It should be in total the same, huh? Because my retained earnings is right. So if we did our math right, it should be there.
312,000.
Okay. Both columns? Looks like it to me. So does this look like smoothing or what? Really their income is 47, 46, 74, and 45. And they made it look like 50, 52, 54, and 56 by playing with ending inventory. If I were an auditor, I'd be calling them on it. Not good. If I worked for the company, I'd be calling them on it. What do you mean? I mean, this is impossible. How can we have these inventory errors every year? And isn't it convenient that our inventory errors cause net income to smooth out like that? Gradual increase instead of bouncing all over the place. Think what their beta is going to look like with the real income compared to the reported income, right? So that's it. That's most people's motivation to do this. Okay, you guys do, how many more years are there? 2 more? Do them. We're starting with no error, right? In fact, do 13 and 14 and then write down 2015 and say there's no error for 2015. Treat it as a new problem, right? You're starting with nothing wrong, right? So do 13, 14, and then say 15, there's no error. And let's come up with an income they would have reported for 15 with no error, make it 62,000, okay? So write down in your book there, 62,000, 2015, 62,000 income, no error, okay? And see if you can work this. It's the same exact problem we just did. This is a good one to do, huh? And by the way, you just relax and think when you do these things. You know how to do it, right? Don't try to remember. Figure it out. Everything. Figure it out. Don't try to remember. The sun moved, remember. Windows open. Trees are starting to get buds on them. The late ones are starting to get buds.
You said 62,000, right?
Yeah, let's make it 62. So they're bumping it by 2,000 again, you know? Playing games with it. Just happened to work out that year for them. Actually, they made it work out. If they don't need an error, just, I guess, the beginning error. The beginning misstatement created the ending. No need for one at the end.
No error either.
What's that?
No error.
No error at the end. Yeah. No error in 2015. That's 62,000 income. Can you do those 3? Martha Thomas knows who you are. I know that. I know Martha Thomas.
His name sounds familiar.
She's one of the assistants. She's called secretary, assistants.
Oh, yeah.
What? I was telling you, you were always at the review session. Make them work.
I have to.
Yeah. Maybe you're working, I guess. I guess. Good. You guys done?
2015.
Oh, okay, what's 7? Or 20?
2013. 2013.
13, what was 14? 13, 14,
13, I got 60,000. 14, I got 50,000.
Oh, so that amounts all over the place. Let's try to do it. See if you have answers there, guys. Okay, so how would you set it up? You could do this if you want. You only got 3 years. Actually, you got all the years. You could do it this way. We started with 2013, did we? 2014, 2015. Let's do that. Okay? And then revenues less expenses. And you instead of saying expense, you could show cost of goods sold, right? It's net income. And let's do 2013, 2014, and 2015. Sound good?
Yep.
Is that what you did? Good. I think that'll work well. And we'll do a T account for equity, you know, to flow through it, don't you think? A good idea. All right. And then for cost of goods sold, it's one of those expense accounts, beginning inventory plus purchases for all 3 years, 13, 14, 15. You need to write all this down. All right, available less the ending inventory is cost of goods sold. And we already know, because there's nowhere at the beginning and nowhere at the end, that the 3 years are going to be in total the same as the incomes we had there, huh? Okay? So, cost of goods sold. So what'd you do? What was wrong at the beginning? Nothing, right? 2013, into 2013, there was nothing wrong with assets, nothing wrong with liabilities, and nothing wrong with equity. True? We're in good shape. So it's just what happens in 14 and 15. Is that correct? Or wait a minute. This 2012, there was nothing wrong, right?
Yep.
No, come on. Okay, 2012, there was nothing wrong. So we start with nothing wrong, and then we'll go right forward. Okay? So in 2013, then, what's wrong with my beginning inventory? Nothing, right? There's no error at the end of 2012. Purchases, nothing. Available, nothing, right? So what do you think about ending inventory? What was wrong with ending inventory?
Under by 2,000.
Okay, so if it's too low by 2, what happened to cost of goods sold? Subtract too little. Cost of goods sold is too high by 2. Revenues are okay, right? Revenues are always okay, I guess. Purchases are always okay, I guess. They didn't say anything. And if they do give you those, who cares, right? Just put it in, right? Whatever's wrong. Okay, and liabilities, I guess there's never anything wrong with those either, right? 13, 14, and 15. Okay, good. Okay, so what's wrong with expenses? Cost of goods sold are too high. That's the expense, right? Makes net income what? Too low by 2. Okay? So if net income's too low, what's wrong with equity? Too low by 2 in 2013, right? All right? And the reason is the assets are understated by 2, and we're in great shape, aren't we? Understatement of 2 in assets, understatement of 2 in equity. Okay, so what did they report in 2013?
58,000.
So you said 58, and you said that is too low by 2, didn't you? So correct was 60, so you got it. That do it? Let's do 2014 then. What's wrong with the beginning inventory? 13 is too low by 2 at the end. 14 is
Too low by 2 at the beginning.
too low by 2. What does that do to what's available? Too low by 2. What's wrong with the ending?
Okay.
2014? I think there was something still wrong.
Overstated.
Overstated by 8. Okay. So what happened? Too low for cost of goods sold because of available, right? And 8 more too low because you subtracted too much ending inventory, didn't you? So cost of goods sold is what? Too low by 10? True? You agree with that? Okay. Which means our expenses are too low by 10. Which means our net income is too high by 10. Right? Okay, so if last time it was too low and now it's too high, let's do a T account for equity again.
Too low by 10.
Expenses are too low, that make net income too high.
Okay.
Wouldn't it?
Yeah.
Did I do it backwards? Beginning inventory is too low by 2, that makes available too low by 2, which makes cost of goods sold too low by 2, right?
Okay.
I subtract 8 too much, it was overstated, right? The 8,000?
Yeah.
Okay? If I subtract 8 too much, that's going to make cost of goods sold too low by 10.
Okay.
So my expense, right? 8
Yeah.
plus 2. Okay?
Yeah.
So then my expenses are too low by 10, makes my net income too high by 10.
Okay.
And that's going to get close to equity. So let's do an equity account, okay? Equity in total, retained earnings, right? I put in, that's retained earnings. First, I start with nothing wrong with retained earnings, right? At the end of 2012. Then I overstate it by 2. Then I understate it by 10. What happens? I have 8 overstated, don't I? Okay? So at the end of 2014 here, I have equity overstated by 8. And what was wrong with ending inventory? It was overstated by 8, and nothing's wrong with liabilities. 8 equals 8, how about that? Got it? So the one that they reported at 2014 was how much? 60? What should it have been? Too high by 8, what should it be? 52,000. Did you, either one of you get that one? Yeah, you did, okay, so you were there, all right? Now what? Let's do 2015, huh? What did I say about 2015? We said income was reported at 2015 as 62, right? All right. We said, well, what would the beginning inventory be off by? Yeah, so if it was overstated by 8 at the end of 2014, what would you say about the beginning? Overstated by 8. What does that do to available? Overstated by 8. Ending inventory we said was okay, right? So guess what we have? Too much cost of goods sold by 8. That's too much expense, of course, by 8, which gives us what to net income? Too low by 8, right? It's too low by 8. And you know what? If you take that understatement by 8, right, what's going to happen to you? Did I do it right? You know what? I wrote those backwards. I wonder you're looking at me kind of strange. These are backwards. They're the right numbers, but they're backwards. The first one was understated by 2, right? Second one was overstated by 10, which makes 8 overstatement, right? And then this one is overstated by 8, so fixing it will take it out of there, and now nothing's wrong. Okay, there we go. All right, so what I've got then is equity's fine, right? Because assets are fine. The errors correct themselves. So what do I need to do? The 62 isn't 62. What should it be? 70? Is that right? It should be 8 more. Then it comes too low by 8. So what would that be? 70,000? Add those 3 together. What do you get? 180? And did I do it right? 60, 52, I did something wrong. 58 left, and it was too low by 2 is 60. 60, oh, it's 10. This one's 50. It's too high by 10. This one's 50. Okay? 2, 10, and 8. Yeah, and then 70. What's 60 plus 50 plus 7? 180. See the advantage of doing them all like that? There you go.
Oh, it's just 50, not 52.
It was just 50, yeah. Because it wasn't 8 off. That's ending equity's 8 off. Income was off by 10. There's what was wrong with 2, 10, and 8. Got it? Do some more of those. There's other ones that are doing the same sort of thing. Okay? Just walk through it, think about it, make up your own, you know. And if I, oh, well, I will give you one. But on a quiz, on a test, on a final, I'll only give you 3 or 4 years. I'm not going to give you a bunch like that.
So this will be on the quiz?
Oh, okay. You can count on that. Fun, fun. All right. What else should we do? want to do another dollar value LIFO problem?
I was gonna ask that.
Which one did we do anyway last time? 825, did I do that one? We're going to do 826. Okay.
You did 825.
Okay, let's do 826. See if you can do it. Once you guys give it a shot first. See if you can set it up. Nope. Give 826 a try. What do they want to know? What's the inventory? They gave the inventory at year end, and they want to know what the inventory is for each one of the years, or those 5 years, using dollar value LIFO. First, get them down to base years. So list everything that's in the problem there. Divide the index into the year end, and that'll get you back to base year, right? And then determine if there's a new layer or not. The old layer will be at the old index, right? Each old layer will be at the old index. Any new layers will be at the new index for that year. If you ever deplete, it's LIFO. If you deplete a layer, it's gone forever, right? Okay. All you're doing. Do a few of these, it'll get easy. And you really want to know this because in the next chapter,
Oh my gosh, there's more inventories.
and this thing is really strange. It's more inventories in the next chapter, and this is the tip of the iceberg on this stuff.
Yep.
Go to work.
I have APO meeting.
What? APO.
Yep.
Big
Alpha Phi Omega.
Ah,
What's the community service?
Yeah.
good. Good thing to be doing.
Oh no.
Oh boy. That's a labor of love. Not fun.
That's fun.
That is the part I hate about nonprofits. Not all the meetings, rules, which you need, by the way. See,
Yeah.
getting there? First thing you're going to do is you're going to take each one of them, right? And you're going to divide the index into it, right? And you will get base year, right? So that column is base year. Yeah? You got base year. So let's do that. I'll set it up the same way you just did. So we've got 2010, 2011, 2012, 2013, 2014, right? Okay. So the year end, okay, Okay, this is what it would have cost to buy them at year end. You didn't buy them all at year end, some were years ago, right? Okay, all right, so 70,000, 90,300, 95,120, 105,6, 100,000, right? You got the index. Now what this is this reflects what changed in the consumer price index or maybe a wholesale price index, how much inflation there's been, right, on these particular products. Okay? So the base year, of course, is 100 because it's the base year, right? There's no inflation this year to this year, okay? It's this year, it's now, okay, at 2010. The next year it costs $1.05 to buy what would have cost $1 in 2010. Got it? Okay, it's just inflation, 5%. The next year is 116, so it costs $116 to buy what $100 would have bought in 2010. Got it? Okay, 120, okay, and 125. Those are straight out of the problem. All you got to do is divide them in. Divide 70 by 100, 90,300 by 105, and so on, right? And what that's going to give me is how much would it cost in 2010, the base year, right? How much would it have cost to buy that inventory, right? Base dollars. So it standardizes them all to the same size. Does that make sense?
Mm-hmm.
Okay, so 70 divided by 100, of course, is still 70, because it's the base year, of course.
What are you doing?
It's 2010. We're doing number 26, right?
Yeah.
Okay.
Oh, and what they saying?
70 divided by 100 is 1.0.
Oh, 1.
No, it wouldn't be 700. We mean it's 100%. The index is 100%. So it's 1.00, 1.05, 1.16, 1.2, 1.25. Got it? It's not 100 times inflation. It's 105 times inflation. It's 1.05, right? It costs 105% of what it cost the year before. So what's 90,300 divided by 1.05?
86,000.
Even?
Mm-hmm.
Nicely made the math work out good. Okay, what's 95,120 divided by 1.16?
82,000.
Okay. You can see in real dollars the inventory went up and then went down, right? It went from 70 up to 86 down to 82. See that?
Mm-hmm.
We're depleting inventory layers, aren't we?
Yes.
Okay. What's 1.2 divided into 105.6?
88,000.
Cool. What's 100 divided by 1.25?
80,000.
Oh, look, we depleted some there too, didn't we? Got the idea? So we build inventory and then we lose inventory. Okay, so now what you need to do is figure out each year's, okay? So what is the inventory going to be? Okay, this is the inventory that's going to be on your books for the each year end, okay? So for 2010, what do you have? 70,000, right? 70,000 times 1 is 70,000, right?
Mm-hmm.
So that's 2,010s. That's a layer of inventory. You with me?
Okay.
So we know that one. What do we have for the next year? You still have that 70, but what else do you have? Another 16 in base year, right?
Yeah.
But that's in base year. I didn't buy those in the base year. When did I buy them?
We bought them next year.
Yeah, and what was the price index that year?
0.05.
You got it. So multiply 1.05 times 16, and that's the 2011 layer. Okay? I've got a 2010 layer and a 2011 layer, don't I?
Okay.
So what's 16 times 1.05? Remember, it's last in, first out.
16,800.
Okay. So what would be the inventory on my books at the end of 2011?
So
There's
this
2010s. 70 plus
That.
16.8. You got it. $86,800 is my 2011 financial statement inventory. Two layers. 70,000 from 2010 and 16.8 from 2011. With me?
Mm-hmm.
What happens the next year in 2012
You have 82.
in base year
Base
dollars?
year.
So do I have any additional from 2012? Of course not.
No.
There's no 2012 layer, is there?
No.
Because I got rid of 4 here, didn't I?
Yes.
So I don't have 16 left from this. What do I have left? That one's now gone, right?
Mm-hmm.
What do I have left? 82 less 70 base year, right?
That's 12.
I've only got 12,000 from 2011 left, right?
Mm-hmm.
And I didn't add anything from 2012, did I?
No.
Right? It didn't grow. So what I did was I depleted part of this layer here. You with me?
Okay.
So what's 12,000 times 1.05? That's what's left out of that layer. It's not 16.8 anymore. What's the 2011 layer now? What's 12,000 times 1.05? 12,600.
12,600.
Got it. So what do I have left now in 2012?
So do you add the 86,800 to the 12,600?
No, because remember the 86.8 included the 70 plus the 16.8, right? We just reduced the 16.8 down from 16.8 to 12.6. So it's 70 from 2011 plus 12.6 from 2011, right?
Mm-hmm.
So where am I at the end here? When I put those two together, what do I have? 82,600. So I still have 2 layers, but I got rid of part of one of them, didn't I?
Mm-hmm.
And how much do I have from 2013? Nothing, because I didn't add any that year. Make sense? It's LIFO. If you don't increase your inventory, you don't have a layer from that year, right? So I've got a 2010 layer left of 70,000, the base, right?
Mm-hmm.
And I have 12.6 from 2011, and I have nothing from 2012. Okay? So let's look at 2013. What happened between these 2 years? Well, it grew by 6, didn't it?
Mm-hmm.
When did you buy those? I think you still have 70 from 2010,
Yes.
12,600 from 2011 that you bought, there's 12 you bought at 105, right?
Mm-hmm.
Well, what was the index this year?
The index this year was 1.2.
You got it. 6,000 times 1.20, right? A lot of inflation that year. So what does that come up to? Actually, there was a lot of inflation the year before in 2012.
7,200.
7,200. You now have 3 layers. You have a 2010 layer, which is 70,000. You have a 2011 layer, which is 12,600 left. And you have a 2013 layer, right, which is 7,200. So you add those 3 together. What's 70 plus 12.6 plus 7,200? Well, all you have to do is take the 82.6 you had last time, right? That's 70 plus 12.6. Was 82.6? Wasn't it?
It was.
Add 7,200 to it, and what do you have? 89,800.
89,800.
Yeah, we're good, aren't
And so we do
we? We actually know what we're doing.
plus 12,600 plus the 7,200
It's 89,800.
is 89,800.
So all you really have to do if they increase a layer is take last year's inventory, 82.6, and add the new one. Yeah. It's just when they reduce it, you'll have to recompute. Okay? Now, the next one reduces, doesn't it?
Yes, by 8.
All right. So what did they get rid of?
They got rid of the.
Now, remember, these are in base year dollars, right?
Mm-hmm.
So we got rid of this whole 6, didn't we?
Yeah.
So that 7,200 no longer exists,
Right.
right? That's gone. And then what else must we have gotten rid of?
Some from the.
Yeah, we got rid of 8, so this isn't 12 anymore. What is it?
It's.
10?
Yeah.
I have 70 from the base year, and then I have another 10 in base year dollars to make the 80, right?
Oh, okay.
And when did I buy those? I bought them way back here in 2011, didn't I? Right? So what index are you going to use?
The 1.05.
1.05. You got it. So what's 1.05 times 10? 10,500, is it?
Yeah. Wait, what was it?
10,000 times 1.05.
10,500.
You got it. And that is a layer from when? Not 2013. It's clear back to 2011, isn't it? So what I have is 2 layers. I've got the original 70,000 base dollars, because I never went below 70, right?
Okay.
And I've got 10.5 from 2011, don't I?
Mhm.
What's 70 plus 10.5? 80,500. It's my inventory on my financial statements, right?
Mhm.
That's my inventory at the end of 2014. I don't have any inventory from 2014 or 2013 or 2012. It's LIFO, right? Okay, let me add one more for you. Let's say now at 2015, I've got 80,000. I reduced my inventory. I just adopted just in time. So I reduced my inventory a lot, didn't I?
Mhm.
And let's say the price index is 130. Do it.
The ending inventory is 80,000?
Yeah, in year-end dollars. And the index is 130. So what do you do here? 1.3 into 80, right?
Mhm.
How much is that?
61,538. Can we round this?
Yeah, it doesn't matter. 530 what?
539.
That's good. Okay? In real life, of course, leave the pennies, I guess. Well, what do you want to do? That's in base year dollars.
Okay.
But what's my original base?
70.
How much of it do I have left? 61,539.
Mhm.
This 10 is gone, which means this 10.5 is gone, right?
Yep.
Everything's gone from 2012, 11, 12, 13, 14. It's all gone, right?
Yep.
What do I have left? Of this
70.
70, I have 61,539 left. But what's the index in the base year? 1. So what's the year-end inventory? 61,539. That's it. That's all you got left. And it's from a 2010 layer, right?
Mhm.
That's at 1.0. 61,539 times 1.0 is 61,539. So if I dip into the beginning, into the base year, that's it. You good?
Mhm.
So you could do a bunch of these, right? And you make up some and do them. Have somebody else do it and you do it. Okay. There's probably other ones too that would work. I bet if you look through the problems, you could find some that would do it. Yeah. Here's problem 811 is exactly that. Give that one a shot too. I bet if you work through that and then compare your answers to what's out there online,
Mhm.
you'll have it. You'll have this wired. Okay?
Okay.
So, do something else. You want to compute the cost of inventory or something?
Yeah.
Something like that. We could do purchases gross and net. Want to do that?
Yeah, we can.
Or we can compute inventory doing periodic, or we can compute inventory doing perpetual.
What was the one you said before?
Well, just immediately before was doing purchases gross and net.
Yeah, let's do that.
Do that. Okay, go over to exercise 8.8 maybe. Yeah, that's kind of a fun one. Okay, purchases recorded. They want you to use the gross method. Let's do both of them. Let's do gross and net with that problem. And then they say, what if they are using perpetual, and then what if they're doing periodic? Oh, and then they did add, how would you record it if net was used? But let's do everything using gross, right? Perpetual and periodic, and then let's do everything using net, perpetual and periodic, okay? So the first thing, this is exercise 8.8 for folks at home, okay? Exercise 8.8, page 454. All right, so what we could do then is we could say, all right, I'm doing perpetual. So if it's perpetual, what do you do when you buy inventory? Debit what? If you perpetually keep track of how much you have, Debit inventory, don't you?
Mhm.
What if I was doing periodic? I would debit purchases. Right? That's the difference. Okay. So this is going to be perpetual gross method. And then we'll do periodic gross method too, side by side. Okay? We can see it. Okay. On the date of the purchase, what would you do? Let's see, it says the first thing they do, what did I say, 8 we're doing?
Mhm.
Okay. Cruise Industries purchases 10,800 merchandise on February 1st, subject to a trade discount of 10%. A trade discount of 10%, what do you do with a trade discount? That's a price reduction, isn't it?
Mhm.
So my purchase really isn't 10,800, it's 90% of that, right?
Mhm.
I'm going to reduce it by 10%. So what's that? What's 10,800 times 0.9?
9,720.
Okay. Debit what for 9,720? By the way, it's going to be credit accounts payable in both cases, right?
Yeah.
For 9,720. 9,720. Because that's how much I bought, right? What do I do under perpetual? Debit what? And perpetually keep track. Inventory. You got it. 9,720. What are you going to do if you're doing periodic?
Purchases.
Yes. Right. Now, second thing that happens is what? It says the credit terms are 315 net 60. It returned 2,500 gross price before trade or cash discount. We need to reduce that then to 90% of it, right? If we recorded it at 90%, we should take it out at 90%, don't you think?
Okay.
So they're returning it. What would you do if they return it? I'd take 2,500 times 0.9, wouldn't you? How much is that?
2,250.
I'm returning it. So don't I owe them 2,250 less?
Yeah.
So debit accounts payable. In either case, I'm going to debit accounts payable, aren't you? Because I owe them that much less. I didn't buy it from them after all. I returned it. Okay. Under the gross method, I put the full purchase in inventory. What am I going to have to take it out of if I returned it? Inventory. Makes sense? I'd credit inventory. 2,250. That working? What would I do though if I'm using periodic? I have a purchases account. There is a contra account that goes with that, named.
Allowance.
Well, not
Well,
the,
no.
but purchase, returns, and allowances. You got it. Purchase, return, and allowance. Okay? You got it. Now, on my income statement, I'm going to show purchases less purchase, returns, and allowances, right? And that's going to be what I use to determine cost of goods sold, isn't it? Beginning inventory plus net purchases, right? Is available less ending inventory is cost of goods sold. Under the gross method, under perpetual, right? Under perpetual, I'm going to calculate my inventory the same way, right? It's going to give you the same cost of goods sold either way. Okay? All right, then what's the next thing that happens? The invoice is paid February 13th. What day was it sold?
It was sold February 4th.
And what are the terms? 3%, 15 days, net 30. Anybody in their right mind would take this one, huh? 15 days, 3%, wow, right? So how many 15-day periods in a year? 360 divided by 15. 365 really divided by 15.
It's 24.3.
Yeah, times 3. Right, because it's 3%. Yeah, anyway, okay. Right, it's unbelievable. Okay, really high interest rate. But, you know, if they're trying to get them to pay early, what will we do here then? How much are we going to pay them? Well, how much do we owe them? By the way, are we within the terms? The original purchase was February 1st, right? This is 2/1. The return was February 4th, right? And I'm paying it 2/13, is it? I don't know why I'm paying early. When is it due? The 15th, right? 15 days I have.
Oh, yeah.
Yeah, so they're paying within the terms, aren't they? So do they get the discount? Yes. So you're only going to pay them 97% of what you owe them, aren't you? Because you get a 3% discount. How much do you owe them? Take 9,720 less 2,250, right? Because you returned that much. You're not going to pay them what you returned, and you also don't get a discount on what you return, do you? So how much do you owe them in accounts payable? How much do you owe?
So if I'm subtracting, it'd be 7,470.
Okay. So I'm going to get rid of the account payable when I pay them. 7,470. In either case, I'm going to get rid of that accounts payable. Would you agree to that?
Yes.
All right. Now what? I'm going to give them cash, right?
Right.
Credit cash. How much?
That's 7,470.
I get the discount.
Oh.
Only 97% of that. 3% is the discount. Let's take 0.97 times 7,470. That's how much I give them.
7,245.9.
7,246. Close enough. Right? And of course, we care about pennies in real life. Okay. 7,246. What's the difference between those? That's a discount, right?
Yes.
If in perpetual, though, you put everything into inventory, when you return some, you took it out of inventory, guess what you do with the purchase discount? Take it out of inventory. Don't you think? How much is it? Your discount was 7,470 times 3%. What is that number? What's 7,470 times 3%? Is it
$224.10.
It's 224? It is, isn't it? And journal entry balance? Yes.
So I just
That's the 3%.
credit inventory?
Yeah.
Oh.
That's because you put everything in inventory in the first place. When you return some, you took it out of inventory. If you get a discount, you take it out of inventory. So that's the 3%. The 97% is how much you paid, right? With me?
So wait, okay. The 97% of the 7,470?
Sure, because you get a 3% discount. If it was a 1% discount, you'd just take away 1%, right? You'd pay 99. The 2% discount, you'd take away 2, you'd pay 98%. True? Okay, good. All right. What you got to do is just keep yourself thinking, moving forward, right? Okay, don't try to remember. Okay, how did this work? How did this work? How did this work? What's going on here? Every time you look at something, right? It's not remembering, it's knowing. Okay, so what must be the case here? I've got to have a 224 on this one too, right? It's periodic. But what did I put it into when I bought it? Purchases. What did I take it out of when I returned? I increased purchase returns and allowances to reduce net purchases. Guess what this is going to be? Purchase what? The discount. I think it's purchase discounts. That's it. So there's the 3%, and there's the 97%. We'll get the same cost of goods sold both ways. Okay? So there's the gross method. Got it? Let's do one more thing. What if they had not? Let's say they had not paid on time, because I guess they're crazy people, right? If they don't pay on time, let's say they pay February 28th, right? It's 2% 10 net 30, so they waited the whole month, right? They're paying them at the end of the month because they screwed up. This is a big mistake. Let's see how much it cost them. What would they debit accounts payable for it, if that happened? What would they debit accounts payable for? How much are they paying off? Still 4740, right? 7470. Whatever I said. Okay. How much cash are you going to have to give them if you don't get a discount? How about 7470? They got to pay 100% of it, don't they? How much did it cost them to fail to pay this invoice on time? $224 thrown away. Right? Not a good decision. You can see why in my life I have hired people to this. Make it hundreds of thousands. Wow, are you kidding me? Put thousands in the back, right? $224,000 thrown away in a $7 million deal. No, no, no. Yeah, we're not doing that. Okay, let's change it to net method. So we're going to do perpetual still, we're going to do periodic still. But what if it was net method? So you just read carefully, what am I asking for, and then do it, right? I'm going to record them at net when I buy them, okay? Make sense? This is what most companies do, by the way, on purchases. They usually record them at net. On sales, we usually record them at gross, and then they'll know how much the sales discounts are costing us. Here, we record them at net, and we expect not to lose any purchase discounts, right? Because we're going to pay on time. So I expect purchase discounts lost to be nothing. If there's a balance in there, I got a real problem, right? Okay, so how would I record it? On February 1st, what would I do? I'm going to record it net, assuming I'm taking the discount. So what would it be? It'd be the 90% times the amount that was purchased, right? Because 10% is a price reduction, right? That's the trade discount. So we said 10,800 times 90% is 9,720, right? How much do you expect to pay, though? We expect to get a 3% discount on that, don't we? So wouldn't it be 9,720, which is the 10,800 times 90%? Take that times 0.97. With me? That's how much you think you're going to pay, right?
Yes.
So I would debit inventory for that amount and credit accounts payable to that amount because I expect to take the discount. How much is that?
9428.4.
28. 9428.
You said that 97.
That's the 9720
times 0.97.
Yeah. Well, 0.97. Is that right? 3% discount would be, yeah, $270. 300 bucks. 9428. Okay. All right. What would we do if it's gross? Or I'm sorry, if it's periodic. That was perpetual. What would I have if it's periodic? Debit purchases. Yes. For exactly the same number. Don't you hope I asked you for one of these?
Yes, I do.
And credit accounts payable? 9428. That look good? Then what? What's the next thing you're going to want to do? Let's do the return.
Yeah.
Now remember, when you're doing the return, how did we record it? We recorded the thing at net. So what should the return be at? Net. Yeah. So on February 4th, they return how much of it?
3%.
I don't know. What they return? They bought 10,800.
Okay.
But then they had a 10% trade discount, and then they took out the 3% purchase discount, didn't they? Right? The cash discount, assuming they're going to take it. So when you return it, you're going to have to do the same thing. So 2,500 got returned, right? That was the gross price of it, 2,500. 2,500 times 0.9 is what you returned. We already know that's 2,250. That's what we did last time, huh? When it was gross. But you'd only take 97% of that, right? Back out. If you put it in at 97, you better take it out at 97. So it'd still be debit accounts payable and credit inventory, but it would be at 97% of the 2,250. How much is that? Times 0.97.
2182. Well, 2183.
So we're rounding. If you'd really keep the pennies, of course, right? Okay?
On my place, if I round for the law?
Yeah, it's not. Yeah. Rounded in yours dollars. If I don't say you do that, you should be. Okay, then what happens here under the periodic method? Remember, here we're perpetual.
Debit. Accounts
And
payable.
here we're periodic. Yeah. Debit accounts payable and credit.
Do I still do that purchases, returns, and
Purchases,
allowances?
returns, and allowances. You got it. And how much?
The 2183.
Yeah. Okay, now you're paying it, right? How much do you owe them? The difference between those two, right? 9428 less 2183, right?
What? 2183.
Yeah. Now what you owe them? So if you pay within the discount terms, you get to take the discount, don't you?
Mm-hmm.
So it'd be debit accounts payable for that difference. How much is that? 9428 less 2183, huh?
7245.
What's that? Cash! Let's make sure we get it right. Okay? Oh, well, first, let's do the other one. If I'm periodic, what would I do? Exactly the same thing. What's left in accounts payable? 9428 less 2183, 7245, right? Is that true?
Yes.
Okay. And credit cash. I want you to look at something here. This was rounding that caused this. But how much did we pay them when, if we were using the gross method? 7246, exactly the same amount that we just did the rounding.
Yeah.
Right? You with me on it?
Yes.
It's the same, isn't it? So the amount you pay is the same, of course, right? The amount you bought is the same, and you still get the discount. But do you see any purchase discount there? No, you don't see one, right? Because you recorded them at net. Okay, now let's do exactly the same thing we did with the last part. Okay? What happened when we paid late? You can't tell that you passed a discount, can you, if you use the gross method? You see that up there? Well, here we're going to be able to tell, because if we don't pay on time, what happens? What would happen at February 28th when we do pay and it's too late? How much are you going to pay? Well, you know what? You're going to have to pay the full $7,470. Does that make sense? Because what you give, here's how you do the net that we bought, right? Take 90% of that. That's how much we actually paid for it, right? And then that's what we have to pay. Right? How much is that?
7470.
You got it. Okay, you're there. So that's it. That's what we have to pay. So you're going to have to credit cash 7470. No matter which method you're using, you're going to have to do that, because that's the amount of cash that's actually paid, right? Whether it's periodic or perpetual, doesn't matter. What are you going to debit accounts payable for? How much do you owe them? 7245, right? That's how much we have left in the payable, but we had to pay more than we owed them. Why? Because we threw away the discount, didn't we? You with me? How much discount did you throw away? $224. Well, 225 with our rounding, right? You see what happened? You had to pay more because you screwed up. And what do we call this? Purchase discounts lost. Remember when we did it on sales? We'd have a sales discount lost that was revenue to us. They gave us voluntarily revenue, I guess, right? This is we voluntarily took a loss. Purchase discounts lost. And where would you put that? Well, you could put it in cost of goods sold if you want, add it to cost of goods sold. Or you could put it down in non-operating as a mistake, right? A loss. Got it? Quit pushing. Randy. Too old. At least not so far. Are you happy?
Yes.
Okay, you can do this. All right, let's try one more inventory errors, and then let's get out of here. Let's do exercise 811. So let's change it a little bit. Let's let's do exercise 811, but let's do journal entries for it too. And it says compute current ratio based on their balance sheet, do it after the corrections are made, and then what will happen to income up or down as a result of corrections. So we'll talk about what will happen to income as a result of it, right? But we'll also calculate the current ratio before and after, and we'll also do the journal entries, okay?
So we're doing 811?
Mm-hmm. So let's do the current ratio before first. What would current ratio be? Net current assets divided by current liabilities? What's current assets?
Yeah. Oh, current assets is 370. 370,000.
You got it. Divided by
200,000.
what's their current ratio? 1.35 to 1, is that what that is?
1.85.
Oh, 1.8.
Let me double check.
You're right. Right, 1.35. That'd be 270. Yeah. Okay. 1.85 to 1. That's how you write that, right? Okay. That's before. Okay. And then we're going to come up with what our net income is after all of our adjustments, huh? If we know our journal entries, we can get the net income, the change in net income. We don't know what the net income is. If they give us the net income, we can calculate the new net income. But it doesn't matter. We'll just look at what the change in income would be. That's what they want down there, right? How much would be adjusted up or down? Okay, you tell me. Goods purchased costing $22,000 were shipped FOB shipping point by a supplier. Have we bought those yet? December 28th? They're shipped FOB shipping point. And we're buying them.
It's ours.
They're ours. We should debit inventory if we haven't yet, right?
Yes.
Okay, it says they received and recorded the invoice on December 29th. So they debited what? Are these guys perpetual or periodic here? Doesn't say, does it?
No.
Okay, maybe it doesn't matter. They're included in their physical count because they were not included in their physical count because they were not received until January 4th. Okay, so they recorded it. So if you think about this, they recorded it as inventory when it came in, or as purchases, right? Either way. But then they did not include it in the physical count. So the ending inventory is what? Too low, isn't it? Ending inventory is too low by 22,000, right? Liabilities, though, it says they recorded the purchase, so they must be, well, either way, they either debited inventory or they debited purchases, depending on if they're perpetual or periodic. But then the ending inventory is still wrong, right? So their cost of goods sold would be what? They didn't include an ending inventory. Cost of goods sold is too high by 22, isn't it? Which causes net income to be too low by 22, am I right?
Mm-hmm.
Which makes equity too low by 22. So what we need to do is we need to add to our income by 22. How would you do that? You would debit inventory, give me the journal entry,
Debit inventory.
and if it's not inventory, if it is inventory, it must not be cost of goods sold. It's either cost of goods sold if I'm doing perpetual, or it's inventory change or income summary if I'm doing periodic count. Either way, it ends up in net income. So I just increased net income by 22, right?
Mm-hmm.
So that entry increases net income by 22,000, right? We got one of them, just like that, okay? What did it do to your current assets and current liabilities? This increased current assets by the same 22, didn't it? You with me? All right, good. All right, let's do the next one. Then we'll just add them all up. What does the second one say? Goods purchased costing 15 were shipped FOB destination by a supplier on December 26th. They received and recorded the invoice on December 31st, but the goods were not included in the physical count because they didn't get received until January 2nd. So what's the error here? It's FOB destination. You didn't receive them until January. Is it your inventory? No. They left it out of their inventory. You like that? Of course, that's fine. So the ending inventory for that one's okay, right? All right. So assets or liabilities plus equity. The ending inventory is okay, isn't it?
Yes.
Okay. We know that. But what did they do? They went ahead and recorded the purchase, didn't they?
Of 15,000.
So they either debited inventory, which ended up in cost of goods sold, if it's perpetual, or if it's periodic, they debited purchases, which ends up in cost of goods sold. So if purchases is too high by 15,000,
Okay.
and the ending inventory is correct, what's wrong? Cost of goods sold is what? Too high by that 15, right? Net income is too low by the 15, isn't it?
Which is equity.
Which makes your equity too low by 15. But what's wrong with liabilities? You recorded a liability, right? Debit purchases maybe, credit accounts payable. You have too much, whoops, your liabilities too much, are too high by 15, huh? Right? How would you fix it? I'm going to credit accounts, whoops, debit accounts payable, they're too high, by 15, right?
Yeah.
Didn't they credit it too much? So here's a current liability that needs to go down. Reduce the current liability. That's going to change your current ratio, isn't it? Right? You have to keep things straight. And what's the credit going to go to? It's cost of goods sold, isn't it? Either purchases or cost of goods sold directly doesn't make any difference, right? That's going to make net income by how much? 15. You with me? Net income's higher by 15. It's sweet. The selling and assignment for Claudia Kishi Company were included in their uh-oh, 13,000. That's not fine, right? What's that? My income 13,000 doesn't it? So what's wrong with my ending inventory? It's too high. By 13, would you agree with that? Okay. Liabilities are fine, right? What must be the case with equity?
It's too high by 13.
Why? Revenues are probably fine. What's wrong with expenses?
That's probably off.
Now wait a minute, I subtracted too much ending inventory. My beginning was right. Assume my beginning was right. My purchases are right. My availables right. And then I subtract 13 too much. What happened to expenses? Too low by 13, which makes net income too high by 13, which is what caused the equity to be too high by 13. This simple little chapter, this makes it hard, doesn't it? Yeah, there's a few things. Okay, there we are. So what will that be? Give me the journal entry to fix it. My cost of goods sold are too low. Debit, cost of goods sold. Inventory is too high. Credit, inventory. Right? What does that do? My net income should be what?
Well, no, it should be down.
Down. By 13, good. And my current assets?
To go up by 30.
Credit?
Down.
Even I can do this. We got it made now. Okay, let's do one more. And then we'll add these up. Okay? Okay, let's do one more. That last one. Freight of 3,000 was debited advertising expense. That's wrong. That one's easy. What do you do to that one? You debited advertising expense instead of debiting inventory, right? Should have been inventory. Or purchases, either one. And should it be included in the ending inventory? Freight in?
Yeah.
Yeah. Okay. So what's wrong? Assets are understated by 3, right? They're too low by 3. Would you agree with that? Inventory should be 3 more. Liabilities are fine. Equity,
Down by 3.
it's too low by 3. Revenues are probably okay. Well, it must be the case with expenses, I guess.
Too high by 3.
Too high by 3. Right? That's because I expensed it instead of putting it in inventory. Right? Okay? That makes my net income too low by 3, which causes the equity to be too low by 3. Okay? What's the journal entry to fix it? I have advertising expense with a debit of 3, and I shouldn't have done it. Credit advertising expense. Is that true? By 3. Okay? And debit what for 3? Inventory. You got it. We're there. Okay? So that's going to make my current assets more by 3. Do you agree with that? And it's going to make my advertising expense, my expenses less by 3, which is going to make my net income what? More by 3. True? Okay, so let's talk about what all 4 of these did. Let's add them up. The net income. What's wrong with net income? Okay, let's just add up the 4. Okay. This made net income 22 more. So 22 positive, right? This would make net income 15 more. What do we got? 37 positive?
Yeah.
This would make net income less by 13. What do we got? 24 positive? True?
Yes.
This would make net income 3 more. What do we have now?
You're at 27.
27.
Can I make a T account for that?
Sure. You can start with the net income and just increase, decrease. No problem. So those 4 added together, there's only 4 mistakes, total.
37.
Now 22 plus 15 is 37.
27.
Less 13, right, is 24. Plus 3 is 27. 27 increase in net income. Got it? Okay, now let's do the current ratio. So you had 370 of current assets. You see that way up there at the top? What happened to current assets? The first one increases current assets by 22. So take 370 plus 22, right?
370.
Am I right? 370 plus 22. This one's current liabilities. Do nothing with that one, right? Is this a current asset? Yeah, inventory is. So subtract 13. So we had 370 plus 22 less 13.
379.
379 now? Okay, and then the last one, we increased current assets by 13, right? So what's current assets now?
Wait, why did we increase it by 13?
Okay, we started with 370.
Okay.
We added 22 to inventory. We subtracted 13 from inventory. You said that's 379, right? And then we added 3 more to inventory. I guess 382. Know you? Current assets are 382. Okay? True?
Yes.
All right. And what's current liabilities? You started at 200, didn't you? And only one affected current liabilities, right?
200.
Debit, yeah, you got it. Debit 15. 185?
Yes.
Divide 382 by 185, and what do you get for your current ratio? That's it. What does it change it into?
2.06.
2-1, right? Set up. You could do this, couldn't you? Practice, practice, practice. Also, do LIFO, FIFO, and average, perpetual and periodic, just like we did in principles, right? Be able to do those, and specific identification, which is easy. Okay? So, give me 20 hours this weekend. You won't believe me. Well, you will too believe because you've seen it, what happens before when you do that.